All eyes on Jackson Hole this morning as the event gets underway. What does it mean for the markets and your money? That's coming up on 3 Minutes on Markets and Money. The Jackson Hole Symposium kicks off today. This is the annual confab of global central bankers that fly in from all over the world to congregate and determine monetary policy for the globe and what that might mean for the markets, of course. This is what the markets are all looking at right now. That's really been the case since the lows back here in July, where the market started talking about a Fed pivot on terms of policy. As you know, again, inflation looked like it may have peaked in the last report. That may not be the case. Fed President Raphael Bostic out this morning talking about, well, basically inflation may stay higher and be more persistent than expected, which may keep the Fed aggressively hiking rates for longer than expected. And again, monetary policy has this lag effect. So again, as they're hiking rates, we're not going to see the effect of those rate hikes now for, really 6 to 8 to 9 to 12 months. So again, a lot of these rate hikes they're doing now won't even show up in the markets or the economy, so to speak, until later on. As markets are kind of digesting this information, the hope is right now the Fed will talk about, maybe we'll back off here a bit, maybe we'll slow down, take a pause, take a breather. But that's far different than the actual Fed moving back to quantitative easing. They're now doing $95 billion a month in quantitative tightening, reducing their balance sheet. Fed rate hikes are still moving up here, expected to hike another 50 basis points in September right now, but odds for a 75 basis point hike are still on the table, particularly if we see some stronger inflation data or more persistent inflation data over the next month or so. So again, as we start looking there, there's no real sign here the Fed's going to back off. Technically, though, markets ran into this kind of very overbought condition, 2 standard deviations above the 50-day. We talked about the market needing to have a pullback here. That started last Friday, continued through Monday and Tuesday. Yesterday saw a little bit of a bounce here. And again, that's not really surprising after kind of such a sharp sell-off here. Markets did go back to very oversold conditions very quickly. It was a very fast drop in overbought to oversold conditions. But we're still pretty much on a very important sell signal right now, which suggests prices are going to continue to be under pressure here, at least in the short term. And as we kind of finish up earnings season, we're going to have to start focusing back on economic data, which is okay, but it hasn't been that great. And we're starting to see some deterioration in some of the more important pieces of economic data that's going to start to weigh over into earnings. And earnings estimates are now starting to get dropped fairly quickly going into 2023. So that's going to cause markets to have to start to reprice expectations for earnings and valuations. But as we talked about yesterday, there's currently resistance right here at the 20-day moving average, and importantly, right at that level, which is about 4160. That is also the tops that we had back here in June, the bottoms that we had back in May, and of course the bottoms we had back in February when Russia invaded Ukraine. So there's a very strong line of resistance right here where the market fell back below. So we broke that support after briefly getting above that resistance level a couple of weeks ago. Back below that, that's now pretty important resistance. Markets are going to probably struggle with that here just a bit. We'll see how the rally goes today, but we're going to need some pretty good news out of the Federal Reserve to potentially make this run back up towards previous highs here as of late. But keep a little bit of dry powder right now. With this sell signal in place, it does suggest that markets are going to be under pressure here for at least another couple of weeks. September tends to be a weaker month as well, and that's also where we have the next Fed meeting. So again, without any real earnings data coming in, economic data continues to be weak, no real news out of the Fed other than probably expectations for rate hikes. That may weigh on prices temporarily. So again, just be a little bit cautious here. That's 3 minutes on Markets and Money. See you back here tomorrow.